One of the things that I love to do is talk to new investors about what they're currently doing with their investments. And really, since about 2020, I typically get an answer like this. I wanted to start investing right away, so I opened up an account and I bought a few stocks. This then leads me to ask, why did you buy those stocks? What's your goal for your portfolio? What's your plan and your strategy? To which they usually respond with some hesitation, I don't know. And that's the problem these days. There's just so much information about investing out there, especially when things kind of exploded online at the start of COVID. Too often I find new investors put the cart before the horse. That is to say that over the past few years, I've seen way too many new investors jump into the market without a plan, think that their investments will go up forever, and then freak out and panic sell when they see the market correct, like we saw in 2022. And that's not how you build wealth. It's not. If you're just randomly buying stocks or ETFs because someone on a social media platform told you that it was going to go to the moon, that's gambling. That's not investing. Investing means having a goal, a timeline, a plan, and following a specific investment strategy to build long-term wealth. And if you're a passive investor like myself, it also means having a strong foundation built with a selection of broad market ETFs, which is what I'm going to discuss in this video. Now, before diving in, I want to say a big thank you to BMO ETFs for sponsoring this video. Now, in case you don't know, BMO ETFs is Canada's second largest ETF provider with over 25% of the Canadian ETF market share. Not only that, they are one of the top thought leaders in the Canadian investing space, providing free and amazing educational content about ETFs on their website, etfmarketinsights.com, and their ETF Market Insights YouTube channel. I'll make sure to link to it in the description of this video so you can check both of those resources out after you watch this. So what do I mean by broad market? First, it's really important to know that broad market does not mean the same thing as total market. Broad market means a large number of stocks or bonds issued by a specific country or region, spanning a multitude of industries and sectors represented by what's called an index. For example, you've heard of the S&P 500, right? This is an index that represents the broad US stock market. It doesn't represent the entire US stock market because if it did, it would have thousands of stocks from big companies to tiny companies in the US. No, it just represents the 500 leading companies in the US and represents about 80% of the US stock market. Similarly, in Canada, we have the S&P TSX Composite Index. Now, this index represents the broad Canadian stock market, but it only covers about 95% of the Canadian stock market. Now, since I just mentioned S&P and the S&P 500 and S&P TSX Composite Index, S&P stands for Standard & Poor's. This is one of many companies that builds indexes. There are a ton of other index providers out there, such as MSCI, FTSE Russell, NASDAQ, and CRSP, just to name a few. Now, it's also important to note that although these index providers do build broad market indexes, like I just shared, they also build indexes that are more specific and niche, such as one to represent Canada's clean energy sector or the US's healthcare sector. This is just to say that not all indexes are broad market indexes, so it is really important for you to understand what is the index being benchmarked by an ETF before purchasing it, which leads me to discuss broad market index ETFs. So if you've ever heard someone use the term index fund, this is what they're referring to: a fund that is mimicking a particular broad market index. Now, these types of funds first became available in the form of mutual funds, but over the past few decades, exchange traded funds, ETFs, have grown in popularity, largely because of their transparency. You can see every single security listed inside an ETF. You can't with mutual funds. But also, they're much lower cost, their fees are generally lower than mutual fund fees, and of course, their accessibility. You can easily open up a discount brokerage account yourself and buy your first ETF practically within minutes. For example, as a Canadian investor, if you want to invest in the S&P 500 and gain exposure to the US stock market, you can do so easily by buying shares of ZSP, the BMO S&P 500 Index ETF, because this ETF has been designed to replicate the performance of the S&P 500 index. And if you've ever been curious about what is inside my investment portfolio, because I never talk about that, this is it. I just invest in a portfolio of broad market index ETFs. But with that, the one question I get super often is, which ETFs should I buy? When it comes to constructing your own investment portfolio, diversification is key. You don't want to just invest in the S&P 500 because that would basically be you putting all of your eggs in the US stock market's basket. That's risky, especially if the US stock market goes down, but the Canadian stock market or other stock markets around the world go up. So the best way to mitigate investment risk is to put your eggs in lots of different baskets. That would look like you investing investing in the Canadian stock market, the US stock market, international stock markets, and emerging stock markets. And depending on your risk tolerance, a 100% stock portfolio may be way too volatile for you, in which case consider adding some bonds to your portfolio, like buying shares of an ETF that gives you exposure to the Canadian bond market. An example of what this could look like is having a portfolio with ZCN, the BMO S&P TSX Capped Composite Index ETF for your Canadian stock market exposure, ZSP, the BMO S&P 500 Index ETF for your US stock market exposure, ZEA, the BMO MSCI EFI Index ETF for your international stock market exposure, ZEM, the BMO MSCI Emerging Markets Index ETF for your emerging stock markets exposure, and lastly, ZAG, the BMO Aggregate Bond Index ETF for your Canadian bond exposure. Like I've said, it's super easy to open up a discount brokerage account, buy shares of these ETFs, and manage your own portfolio. The hard part I see investors have with self-directed investing, however, is deciding on the best asset allocation for their portfolio. And asset allocation means what weighting should each of these ETFs have inside their portfolio. Not just that, also rebalancing their portfolio so it maintains that target asset allocation that they set for themselves, and honestly just second guessing themselves along the way. Now, there are, of course, a ton of different model portfolios out there that you can use when constructing your portfolio, and there's lots of spreadsheets and apps to help you rebalance your portfolio. But honestly, one really great solution is just to invest in an asset allocation ETF. This is an ETF that houses other ETFs and is rebalanced for you. Now, although the MER is slightly higher on these funds, they can save you a ton of time and effort. And yes, if you're curious, I am investing in one of these funds for one of my portfolios. Now, if you're curious, some examples of these asset allocation ETFs include ZGRO, the BMO Growth ETF, and ZEQT, the BMO All Equity ETF. But if you want to learn more in-depth information about how asset allocation ETFs work and what's going on with them, I did make a video about it, so make sure to check it out. I will link to it in the description of this video so you can check it out and learn more. Now, the last thing I want to touch on is the concept of core and explore. Listen, it's important to have that core portfolio to build long-term wealth, but I completely understand if you want to explore outside of that. Maybe you want to add something different to your portfolio and, add some more diversification by investing in some other uncorrelated asset classes such as precious metals or REITs. Or maybe you want to increase your exposure to some megatrends like genomics or autonomous technology for the potential of earning some higher returns. In that case, you want to carve out a percentage of your overall portfolio, between 5 and 10%, to explore outside of your core portfolio. Just remember, although there is the potential of earning higher returns with this type of core and explore strategy, there is no guarantee, and you may actually earn lower returns because maybe that megatrend or that asset class goes down in value instead of up. So there you have it. Hopefully you have a much better understanding of broad market ETFs, but also building a portfolio for long-term wealth building. A big thank you once again to BMO ETFs for sponsoring this video. Make sure to visit bmoetfs.com for more information and educational resources on what I shared in this video, as well as their website, etfmarketinsights.com, which I'll link to in the description for this video. And make sure to also check out 2 webinars about broad market ETFs on their ETF Market Insights YouTube channel that explore this topic even further. And I'll also link them both in the description for this video so you can easily find them. And lastly, if you have any questions, make sure to put them in the comments. Make sure to like this video if you liked it. And if you're not already subscribed, make sure to hit that subscribe button. I would really appreciate it. But that's it for me. Thank you so much for watching, and I will see you in my next video.